Welcome to The Explainer. Today we're diving deep into what I can only describe as a completely game-changing, record-breaking quarter for Tilaknagar Industries. If you've been tracking the Indian spirits market, you know that House of TI has been making some serious strategic moves lately. But the numbers they just posted for Q1 FY27, they demand a much closer look. We're going to unpack exactly how they've engineered this growth and what it really signals for their future. Let's get right into it. 1,026 crore rupees. That is their net revenue for a single quarter. Just let that sink in for a second. This isn't just a tiny step up, it's a massive leap that establishes the undeniable scale of their current success. Hitting the 1,000 crore mark in what is historically a softer first quarter proves that all their recent strategic pivots are paying off in a very tangible way. To truly understand this transformation, here's our roadmap for today. We'll hit 6 key areas. First, that record Q1 financial performance. Second, driving volume and share. Third, the mechanics of integrating Imperial Blue. After that, we'll explore building a luxury portfolio, unpack their debt and cost optimization, and finally, map out the road to FY30.
All right, kicking things off with part 1, record Q1 financial performance, and the numbers behind the growth. So, looking at the top-line growth, it just pops right out at you. Net revenues skyrocketed to 1,026 crore, up from just 394 crore in the exact same quarter last year. EBITDA? That jumped significantly to 148 crore, which gives them a really impressive 14.5% EBITDA margin. Now, you might notice profit after tax is sitting at 76 crore compared to 89 crore previously, but here is the kicker. They pushed out a massive 8.7 million cases. So what's the big takeaway here? It's the sheer operational leverage they've unlocked. They are literally pushing vastly more product out the door, all while fiercely protecting those healthy double-digit margins. And when you adjust for subsidy, we're staring at a whopping 189% year-over-year net revenue growth. I mean, wow. In the consumer goods and spirits sector, seeing revenue leak that sharply in a single year usually means one of two things. A massive new acquisition just came online, or the brand did a total 180. For Tilaknagar, it's actually a really powerful combo of both, totally cementing the reality of this broad market expansion. But look, it definitely wasn't all smooth sailing. The management team had to navigate some seriously rough waters. We're talking severe headwinds, things like ongoing geopolitical tensions driving up packaging costs, especially for glass. Throw in the disruptions from state elections in key markets like Assam and West Bengal, and honestly, margins could have easily collapsed. But they didn't. They managed to pivot those headwinds right into tailwinds. By capitalizing on softened extra-neutral alcohol prices and just relentlessly optimizing their supply chain, they protected their profits. And this matters, right? Because it proves their business model can actually take a punch from external shocks and stay standing. Moving on to part 2, driving volume and share, the core engines of this growth. Now, Mansion House Brandy continues to be an absolute beast when it comes to volume. They moved 2.6 million cases in this quarter alone. And what's crazy is that Q1 is historically a softer quarter for brandy, yet they still pulled off over 7% year-over-year growth. This is literally the second largest selling premium brandy in the world. It basically acts as this massive, stable cash cow that gives the company the foundation it needs to fund its bigger, bolder strategies elsewhere. And you can see that bold expansion perfectly with Imperial Blue. The momentum here is just off the charts. The brand crossed 2 million cases in May and June alone. Because they're moving at that kind of velocity, they expanded their market share by 150 basis points quarter over quarter across North, West, and South India. Just to put that into perspective for a second, Imperial Blue is now the 3rd largest whiskey globally. So this isn't just a hit product, it's a major, major asset that is actively redrawing the market map in Tilaknagar's favor. Okay, let's look at part 3, integrating Imperial Blue and the operational mechanics behind it. So, acquiring a brand of Imperial Blue's size is one thing, but actually integrating it profitably, that's a whole different ballgame. This timeline shows exactly how they're doing it. Step 1. Roughly 90% of operations have already been transitioned out of their Transition Services Management Agreement, or TSMA. Step 2, they're down to just one single state remaining with a hard exit deadline of Q4 FY27. And Step 3 is the real game changer for profitability. Those transition expenses were eating up about 8 crore rupees a month, but now they're getting halved for the rest of the year. Shedding those temporary integration costs is going to drastically improve their baseline profitability going forward.
Which leads us nicely into part 4, building a luxury portfolio, and their big shift to the prestige and above category.
Just take a look at the Monarch Legacy Edition. This represents a massive shift for the company. Being India's first luxury 100% grape brandy, releasing something like this is a huge signal to the market. It tells us Tilaknagar isn't just interested in churning out high-volume, regular segment spirits anymore. No, they are actively pivoting right into the high-margin, aspirational luxury spirits segment. They are trying to fundamentally change how you and I perceive the House of Tilak.
And Monarch is definitely not a one-off. The House of TI premium pipeline is aggressively rolling out craft and contemporary spirits to basically fill every single white space they can find in the premium category. We're talking Seven Islands Pure Malt Whiskey, Samsara Gin, Amara Vodka, and Satara Rum. Plus, they've upped their stake in Spaceman Spirits Lab, tapping right into that booming cocktail culture. The real strategic genius here? They are taking Imperial Blue's massive, newly acquired distribution network and using it to seamlessly launch all these premium brands across the entire country.
To really grasp this, just think about Tilaknagar 2 years ago. They were heavily a brandy-first company, with over 85% of their volume totally concentrated in South India. Now fast forward to the road ahead, they're a true pan-India, multi-category business. Their volume has totally flipped to over 65% whiskey and about 30% brandy. I mean, talk about a corporate transformation. They've successfully diversified their geographical footprint and their product categories all in one swoop.
All right, part 5, debt and cost optimization. Let's see how they're strengthening the foundation.
Because look, expanding a luxury portfolio like that requires some seriously smart capital management. Currently, their net debt sits at 1,911 crore rupees, but it's structured really strategically. They locked in a 6-year term loan that comes with a 2-year principal moratorium. Basically, that gives them the breathing room they desperately need right now to invest in growth without crippling their cash flow. On top of that, external policies are actually breaking in their favor. The recent India-UK free trade agreement slashes Scotch import customs from a punishing 150% all the way down to 75%. As they scale up that premium whiskey pipeline, this massive drop in raw material costs is going to act as a huge tailwind for their margins starting right in Q3. And there is a very deliberate vision behind all these numbers. Chief Marketing Officer Ahmed Rahimtullah put it perfectly. He says, as we move ahead, our focus remains on building enduring brands across our portfolio that deliver sustainable volume growth, premiumization, and long-term value creation. So you see, this isn't just about grabbing a quick quarterly win. This is a meticulously planned long-term shift toward premiumization.
Finally, we arrive at part 6, the road to FY30 and their future projections.
This growth roadmap outlines exactly what we should be watching for. Right now, in FY27, we're in a bit of an integration and consolidation phase, targeting high single to low double-digit volume growth. But cast your eyes toward the horizon. From FY28 to FY30, as that new premium pipeline fully matures and those pesky integration costs completely vanish, they're projecting mid-teens revenue growth. And by FY31 and beyond, they are targeting an accelerated growth phase with sustained double-digit volume growth. They are very purposefully transitioning from just laying the groundwork to absolutely slamming on the accelerator.
Which brings us to the ultimate question. They are officially targeting an EBITDA margin of 16 to 18% on their combined business by FY29. So, with a newly dominant multi-category portfolio, a highly streamlined pan-India distribution network, and a fast-growing luxury pipeline, is House of Tea positioning itself to be the new undisputed king of Indian spirits? Well, they've certainly laid out the blueprint for it today. Thank you so much for joining me on this explainer, and I will see you in the next one.